Welcome to QAV America, episode 6. Tony Kynaston.
I like the way you
How are
say that.
you?
QAV America. It's like a campaign
You like
ad,
that?
yeah. It's morning in America. It's it's QAV in America.
Yeah.
Mm.
We are not in America,
No.
but if you are listening to this in America, hello, welcome.
Yeah.
Thank you for joining us.
Pay our tariffs.
How are things?
Good.
Yeah. We need the money, pay our tariffs.
Yeah.
We don't get the money, but pay it anyway. Well, Tony, I'm going to do a pulled pork today, but a couple of things I wanted to cover off before we get into that. We don't need to talk about Joe Biden's prostate cancer, although that's something that I'm sure Americans are talking about. One of the things that we track on QAV, for people that are new listeners, who I assume most of you are, one of the things that we do each week when I do my buy lists is we look at the commodity prices, and because there's a number of stocks, particularly in Australia, that are quite often in our buy lists that are tied to commodities. They're mining companies or they're agriculture companies, or what else do we have? Mostly mining and wheat are the ones that we tend to look at.
Oil, coal. Yep.
Exactly. So one of the things that we've noticed in our commodity research this week is that iron ore has just become a buy again. When we say it's become a buy, we track these commodities the same way we track stocks. We put them on a 5-year monthly chart, and then we draw 3-point trend lines to determine where the buy trend line is and the sell trend line is, and we determine whether or not the commodities are in a buy or a sell state from our perspective. And then if we have a stock, say a mining company, let's say a company that mines iron ore, if the iron ore itself, the commodity itself, is in a sell state, we won't buy the stock, regardless of what we think about where the company's financials are at and whether or not it's in a buy state. Because what we've learned over the years is that the share price of these mining companies lags, but it tends to follow the state of the commodity, the underlying commodity. So with that in mind, iron ore has just become a buy again after being in a sell state for a couple of years, more or less, I would hazard a guess.
Yeah,
it's been falling, I think.
Yeah.
Okay. I could look it up because I do track it, but I can't be bothered right now. And wheat has just become a buy as well. Now, in Australia, we have a pretty close, pretty good understanding, let me say, of which companies this affects. In the US market, I don't as much. So, but the way it plays out usually is if we hold stocks in our portfolios that are tied to these underlying commodities, when one of them becomes a sell, we will sell the stock. And if we're looking at stocks to buy on our buy list and one of them is tied to an underlying commodity, it can determine whether or not we will or will not buy that stock, all else being equal. So just shouting that out I didn't come across anything in my recent US buy list that would be affected by this. I don't really know who the big iron ore or wheat players are in the US. But if there is one on your buy list, you might want to take note of the fact that iron ore is now a buy and wheat is now a buy, from our perspective anyway.
Wheat's probably a big thing for the US for big companies like ConAgra, I'm guessing. Well, I'm not that familiar with ConAgra and big farm-based companies like that, so that might come onto our buy list. Iron ore, I don't think a lot of that's mined in the US. But the other thing I'll say about mining companies is they often base themselves on the Toronto Stock Exchange, which is a resource-based country in the same way Australia is. So oftentimes US companies may list there because it's a market which is more used to valuing mining stocks than the US market. But there'll still be commodity stocks on the US, so your point's valid. You might want to edit this next bit out, Cam, and I'm not sure if it applies to wheat and iron ore, but we may have to, the graphs we are using A might be in Australian dollars and B might relate to Australian markets. So I don't know if iron ore has a different graph if it's sold from the US or not, is I guess what I'm saying.
Yeah, I some of the stocks that I track are US. I know I look at a US gold price.
Yep.
I'm not sure about the others, but it's a good point.
Mm.
I just asked GPT. It said there are some publicly listed iron ore mining companies in the US, although it's relatively limited compared to Australia. There's Cleveland Cliffs, which is ticker code CLF. There's the United States Steel Corporation, which has the ticker code X. I wonder how much Elon Musk has offered him for that. I bet you he might take over United States Steel, which reminds me of that line in The Godfather Part 2 when Hyman Roth says to Michael Corleone, "Michael, we're bigger than US Steel." I'm sure Elon can say that now, and he might buy US Steel just to get the share, the ticker code. And it says Mesabi Trust, ticker code MSB, is a royalty trust that receives income from iron ore mining operations. US Steel owns and operates the Mintac and Keetac mines in Minnesota, producing iron ore pellets primarily for its own steel-making operations. With some companies, and US Steel is probably one of those, I suspect, would be involved in a number of different commodities that we would probably look at. And then we tend to look at how much of their revenue is derived from each of the commodities and work out, if one commodity is in a buy state and one's in a sell state, which is the most relevant for that company, et cetera, et cetera. So as we go forward with the series, we will no doubt have specific examples that we'll be able to dive down into. Well, one of the other things that I wanted to talk about today, we just done this on our Australian show, and I'm going to throw it in here, is play some clips from an interview that was recently on Tobias Carlisle's podcast. So, I don't know, for folks out there who don't know Tobias Carlisle, he's former Australian, still an Australian. He's lived in America for a long time. Runs a couple of funds, wrote a great book on value investing. He's been on our show once or twice, is coming back on as soon as I can lock him down. And he does a podcast called the Acquirers Podcast. It's a value investing podcast. It's really great. And I was listening to it. I don't listen to it very often, but because I don't listen to podcasts very often, I'm too busy making the bloody things to listen to them. But I was listening to one recently, a recent episode, and he had a guy called Rich Pzena on, Pzena. Rich is the founder and chief investment officer of Pzena Investment Management, a New York-based deep value investment firm with $34.9 billion in assets under management. And he got started in the early 80s. People may know of Joel Greenblatt. I'm sure we've talked about him from time to time. I think I actually did reach out to him at one point, tried to get him on the show. But he's written a number of great books about investing, like the little book that beats the market and a bunch of others, Common Sense, The Investors, something. He's a successful value investor over there. So he and Rich went to, I think it was Wharton together, business school. And in 1981, they wrote a research paper, How the Small Investor Can Beat the Market. It was their master's thesis. And they were trying to examine the performance of securities that were trading at or below liquidation value during the period of 1972 to 1978 in the US. I think they were kind of trying to update the premise of Benjamin Graham and, trying to do some academic analysis. Obviously, value investing wasn't that popular back then, as it is still not that popular now, really, I don't think. But
Strange, isn't
it? Yes. Although there were, I don't know how many tens of thousands of people at the Berkshire Hathaway AGM the other day. But they wanted to put to test the theory that stocks that were trading below their liquidation value with a low price to earnings ratio whether or not they had outperformed the rest of the market. So they ran that, and funnily enough, they decided that it did. They did, on average, beat the rest of the market. So it was a study that verified the basic premise that if they have a low price to earnings and they're trading around their intrinsic value, that they tend to outperform.
But does that mean you and I can go to Wharton Business School with a dummy portfolio and gain some MBAs?
You, I think. Me, not so much, unless I
copy.
get it.
You can crib.
Like the award that Markham gave me in Ajaccio, my Napoleonic award. It was for not doing any actual research about Napoleon, it's just talking about other people's research about Napoleon. That was what I got my Napoleonic medal for. Talking about other people's hard work. So anyway, I wanted to play, I'm going to steal from this show a couple of clips because I was listening to the whole thing going, I wish Tony was here. I wish I could see what Tony thinks about that. And I thought, bugger it, I'll just steal it with full credit to Tobias Carlisle. I'll confess to it when he comes on the show. And to Rich Pzena. Hopefully these guys don't get a mind. I mean, it's out there. It's in the public eye. It's not a premium podcast or anything. It's freely available on their YouTube. So let me play this first clip, and I can't remember what this is about, but we'll work it out as we go.
So I'll tell you my story from 1999. We had started in our business in 96, and we had a good first couple of years and got to a break even, and we're feeling good. And then we went through this 10 straight quarters of massive underperformance compared to the broad market. And I had a client who came in, sat in our conference room, and she walks in the door and says to me, "My grandmother's a better investor than you are." And all you have to do is buy Cisco. Everybody in the world has figured this out except for you, and you're just stubborn. Try to go through arithmetic with her. And I said, you realize that Cisco is now at a $500 billion valuation, first company to ever achieve that mark. And you're used to double-digit returns. You would be unsatisfied with anything less than 15% a year. So if you bought that whole company for $500 billion, they would have to earn $75 billion a year for you to get your 15% return, and they earn one. Don't you think there's something wrong with that? And she just looked at me and said, "You don't get it, do you?" To which I agree.
You're right. I don't get it.
And that was going to be the backbone of the internet. It was all just as exciting as it is today with artificial intelligence. And so
was that a very painful time for you, or was it like you just kind of recognized that, this is just craziness and I know that the world will get back to reality at some point?
No, I mean, when you're a struggling business that just achieved profitability and now your clients are telling you you're an idiot and they start their accounts, we weren't sure we were going to make it. And in fact, Joel Greenblatt, who you mentioned earlier, that was my partner at Wharton in our little research project. He was my backer in getting going in this business, and we went in the red, and we got an offer from another firm to buy us. It would have gotten all of us a job. Here was the deal: Joel could get his money back, and we would all have a job. And I said, "Joel, it sounds like a really good deal. You should take it." And Joel said, "No way. Whatever you need to make it through this period, you have a blank check." That's pretty much what he said.
Incredible.
And he didn't ask for any incremental equity in exchange for that. Now, he must have been really prescient, because that was in February of 2000 when that happened. And March 9th, it turned around, and he never had to put another penny. He never had to put a penny in.
I thought that was a great story. It just reminds me, I was talking to somebody the other day, one of our QAV club members, who got started in early 2022, just as everything crashed with interest rate rises and Ukraine and, trade wars and all that kind of stuff. And I was saying, yeah, look, from my limited experience with this, but also looking at Tony's numbers and reading Buffett's stuff over the years, the way it works with QAV, I think, tell me if you disagree, but we have once every 5 to 10 years, we have one really, really good year where we massively outperform the market. And then we have maybe another year that's pretty good, but not as big as that one, not like 2-3 times the market performance, 3 times, 4 times the market performance. And then the rest of the time, it's sort of a little bit better, a little bit worse, kind of, averages, average performance. But you got to be around for that 1 or 2 really good years in the decade where the system really outperforms. And the rest of the time, it's sort of, tracks along and, doesn't revert to the mean, but goes back down. That's where the average 20% comes from. Like in the 6 years we've been doing this, whatever it is, we had that one really good year during COVID that really kicked the numbers up. And since then, it's been okay. Like this year, we're up 30-40% on the market. Last couple of years, it's been touch and go, a little bit above, a little bit below. But that one really good year has put us in a good position for the long haul. So it's good. I like it when I hear guys like that are very successful that had a couple of really, really bad years, but they just stuck to the strategy. And, luckily in their case, he didn't have to bail out. Greenblatt backed him. Hard to say Greenblatt back. Can you say Greenblatt backed 3 times fast? You probably can.
Greenblatt backed 3 times fast.
Oh, yeah. Very good. Yeah. Very clever.
I don't know if I've ever thought about it that way. I just think of it as being volatile if you're a value investor. Sometimes you've got huge tailwinds because basically the way I look at it is the market tends to back growth stocks. And that's when we tend to sometimes underperform or outperform a little bit. But it's when the market goes, oh, okay, growth can't go on forever. That's when the value investors have a really good run. So, yeah. I don't know if it's every 5 years or 6 years or 2 years or 10 years or whatever, but it's more around things like the dot-com bubble bursting. When the market wakes up to itself and comes to its senses, as Buffett used to say, when the tide goes out, you can see who's been swimming naked, basically. So it's tidal. It's when the
tidal, yeah.
When the tide goes out, when people say, "Hang on, you can't," as that chap said on the video, then you can't have a market cap of $500 billion and make $1 billion a year. That's a very high price to earnings ratio. It may have been acceptable while you're growing, but as soon as you stop growing, the market cap drops dramatically to meet the earnings.
I hadn't thought about Cisco in years, but I can remember when Cisco was the golden child of the tech industry. I had friends who were working there, people who would leave Microsoft and go to Cisco, and they were paying everyone through the nose salaries and stock options, and it was insane.
I remember, you just reminded me, I remember being at a dinner party once around that time with people at a friend's house, but they had some of their other friends there. I didn't know the people, but a couple of them worked at Cisco. And I remember leaving the dinner party thinking, how do they even get a job? We're just that bad. They were awful. Yeah. Anyway, so
I'm just looking at Cisco's share price. In August 2000, it was trading at $68. Then by February 2001, it had dropped to $23. And it stayed there until 2017. We got up to 37, and it's now back up to $63, $64. But it's taken 25 years to get back to where it was in August 2000. So congratulations to those people who will never sell investors.
Hopefully they got paid dividends along the way, but probably not. Hey, we should, I don't know if we have it on our coffee cup, I don't have it handy, but we should add "You Don't Get It" to our list of this time it's different quotes.
Yeah, you don't get it. That's
you
right.
don't get it. Yeah.
He actually, I'm not sure if I've got it in my list of clips to play, but he does talk about volatility at one point in this interview where he says, yeah, volatility, as value investors, volatility is our friend, which is something I've heard you say. He goes, I like volatility, you know. Doesn't bother me. It's what creates opportunities for us as volatility, right?
Correct. Yeah.
Because they talked to it at one point, and maybe in my clip, so I'll just shut up and I'll skip to the next clip.
We're looking at the metric. We use one metric: price compared to normalized earnings. And normalized earnings, it's a concept, but it's not a complex concept. It's what should the business earn over a full economic cycle, not the peak, not the trough, but on average, what's the earnings power of this business? And it's informed by the history of the business. It's informed by the competitive positioning. If you talk about stories of things that you've invested in, if we were talking about the internet bubble, well, COVID was another opportunity to buy things at crazy prices. And we can save this for a little bit later, but I don't think we have the same opportunities today. But COVID we did, and our biggest holding became, in probably by the end of the second quarter of 2020, GE. You can't imagine a worse business than building jet engines during COVID. And it's not only that travel was down, the number of takeoffs and landings were down 60%. But the volume of GE's business was down more than that because, first of all, nobody was buying new airplanes, but most of their revenues came from the repair and remodel, the repair side of the business, the spare parts business, because that's the high margin business. And so if you were parking airplanes, you would operate the ones you weren't parked until they had an overhaul date. And then you would park it and pull another one out, and you would spend no money on maintenance. So their revenues were down 70%, something like that. And imagine a giant manufacturing operation with an R&D operation with a 70% revenue decline. It had 20% margins before that, or 22% margins.
That's real operating leverage you start to see there, right?
Yes. So their free cash flow rate, if I'm remembering my numbers correctly, and I think I'm pretty accurate, it was at negative $7 billion a year. And the stock went down to $5 a share. And this was a stock that used to be the biggest company in the S&P 500 20 years earlier at $70 a share. So you're buying it down 90% from its high. Now, granted, a lot of stuff happened in the interim. But when you visited the company, they didn't know what was going to happen. All they knew was that they had to be focused on costs and survival and liquidity. And if you have $7 billion negative run rate, you better do something about it. But they also, what made us comfortable is they had $50 billion of liquidity, of cash and credit availability. That meant they had 7 years to fix the problem. And their new CEO was telling us that they were going to let go 14,000 people and they were going to get the costs down so that they could at least be break even without a revenue increase. And as we calculated it, without inside data, just trying to get a sense of what this company would earn if permanently air travel never recovered. And that was our downside case. And our arithmetic, and you can find flaw with it, but it was around 75 cents a share of earnings, from a negative $7 billion run rate to a positive, whatever that was, it created 75 cents a share, and the stock was $5. So I said, I could, if the world doesn't recover, I can lock in a 15% annual return. And if you listen to Culp, who was the new guy who had this history of running industrial companies with 30+% margins, he said, this should be one of those. That's what he was telling us. this should be one of those. It shouldn't have been a 20% margin business. We're going to run it at 30% when we get back to normal. And 30% margin, you would have had something like $2 of earnings on a $5 stock. So you sort of say, wow, the downside cases, I make 15% a year, and the upside cases, I make 40% a year. Why? What am I missing? And that was the kind of opportunity. Now, that was one of the extreme ones, admittedly, but that was the kind of opportunity that was available.
Yeah. And I assume he's talking about GE Aerospace there. This stock with the ticker G. I can't find it back in 2020 at $5, but I see it around about $30 a share. It's now trading at $235 a share. But it might be another company. But just I just like the basic idea of that in terms of, opportunities, right? Which is, as you say, tidal, cyclical. Great business, went through a really tough time for reasons outside of its control, and the share price collapsed because no one knew what was going to happen, but they came in and thought, no, this is a good business, and the numbers made sense to them. So it's that kind of cyclical being. It's like, it gets back to what Buffett was saying, and whoever was it, Greg, I think, in the last AGM, about they do a lot of work to be ready to move quickly when the right opportunity comes across their table.
Well, that is classic Buffett, isn't it? He's greedy when others are fearful. He's buying when there's blood on the streets. I mean, he's that same sort of paradigm that was just described in that clip is what Buffett's been doing his whole investing career. There was the olive oil scandal at Diners Club, and et cetera, et cetera, et cetera. Just he thought Coke was over depreciating its assets and would write it back. He just, with that same kind of insightful analysis, he calls it the moat. This is a company, GE, which is probably going to withstand some big shocks because they've got a lot of cash. It's a well-known brand. It's a big company. It's when things are normal, it operates at 20% plus margins. And he buys it when it's ridiculously cheap and waits for it to get back to normal.
All right. So then I guess I can get into my pulled pork on, unless you've got something else.
No.
So the deep dive I'm going to do this week, Tony, is a company I never expected would be on our value buy list. But in retrospect, it makes perfect sense that it's on our value buy list. This is Ford Motor Company, who has the ticker F, just almost as cool as United States Steel X.
Comes before US Steel in the alphabet. Maybe they're bigger than US Steel.
Yeah. So, it's obviously a very old, very large company. We don't need to explain who Ford Motor Company is. I used to work for Ford Motor Company.
Really?
One of the first jobs I had in my late teens was working for Ford Credit,
right?
Which is, as it turns out, one of the more profitable parts of the Ford Motor Company today. In fact, when I was doing my analysis on it, I had to decide whether or not I should be looking at the revenues and the profits of Ford Motor Company and setting aside Ford Credit or not, but I decided not to. And one of the reasons I wanted to do this today is that I got the heebie-jeebies a little bit about this, as I often do, particularly when I'm looking at US companies. And after you talked me out of all of my heebie-jeebies last week, not all of them, except for the one where the CEO suddenly resigned, I thought, all right, well, I'll just throw this one out there and see what Tony thinks after we've talked about it a bit. Is it a value buy or a value trap is the question I was asking, because it's obviously a very large company, but it also has a lot of problems, a lot of challenges. There's a lot of risks. There's a lot of issues. And generally speaking, when I'm investing using the QAV system, I don't pay much attention to any of those things because I'm just looking at the numbers. I'm not looking really at the macro or micro level stories of these companies, as long as they're not, in deep doo-doo or anything like that. I look at them to a very, very high level and make sure there's nothing I should be aware of. But I don't get, unlike Buffett, we don't get deep into the weeds of these companies. We're not full-time professional, got nothing better to do than sit around reading financial reports sorts of investors. Where get in, get out, and get double market returns with as little effort as possible. Value investors.
Yeah,
is that fair?
People won't have experienced the high levels of my laziness because if they haven't listened to the Australian show for the last 5 years, but they will.
Tony, who developed this system, is extremely, I won't say lazy, prioritizes golf over everything else. Tony doesn't want to, he's not Buffett. He doesn't want to sit around reading annual reports all day long. Doesn't even want to reply to my emails most of the time, my text messages. I sent Tony an email about a week ago about Stockopedia's price to operating cash flow calculations. He probably hasn't even looked at it yet.
I have looked at it.
Because he's got better things to do.
That's also true.
But look, for most people listening to this, unless you're a full-time professional investor, you've got a life, you've got a job, you've got a business that you're running, you've got a family, you've got to go to Kung Fu 10 hours a week if you're like me. You've got other things to do, and QAV is designed to get you the best possible return with the lowest amount of effort and risk, really, outside of maybe buying an ETF. You get better returns, but with slightly more effort, but not that much effort.
Correct.
So, Ford Motor Company. So when I do drill down into these businesses, when I go, oh, shit, I don't know if I want to buy this. This has got some big challenges. Or maybe I should be wary of this, but then
classic sign of a value stock, isn't it? Just like that clip.
Well,
about
Rich.
GE. Yes.
Yeah. Well, maybe it is, but see, here's the thing. Rich is very, very smart. I'm not. So he's able to assess whether or not, and all of his analysts who work for him, etc., are able to assess whether or not this is a good risk or a bad risk. I'm not that smart. So I just rely on the numbers and the system, QAV, to give me a score and a result. And, at the end of the day, what I usually figure is if it's made it through the process of QAV and it's on the buy list and there's no flashing red lights when I look at it at a high level, it's probably good enough. And if it's not and it goes wrong, then I sell it because our sell triggers will get triggered and I get out. So I really...
Yeah. I just want to add to
worst
that.
Worst case scenario, I sell it. Yeah, sorry.
It's like, I just want to add to that. The QAV is kind of designed to automate the process that Rich spoke about before, which is basically saying he's finding a company which is very solid, has lots of cash to weather through the bad times, no debt or little debt, has been operating consistently over a period of time, and has hit the skids for whatever reason. Like the macro side of things, or something's happened within the company which has caused the share price to drop for whatever reason. And we have our red flags, like you alluded to before. If the CEO resigns unexpectedly, or the CFO, or an independent director, then we don't like that. We don't buy it. And if that's caused the stock to depress, then we'll pass. But if it's the fact, and I'm not foreshadowing your forward analysis here, but if it's the fact that it's a big company that's been around for a long time, throws off lots of cash, and people are unsure about its future, we're going to take, the numbers are going to tell us you can buy this at a reasonably cheap enough price that you get paid back quickly from its cash flows. And so you're taking as little risk as possible, below our threshold for risk tolerance, I guess is one way to put it. So, the way we mitigate risk in the QAV system is we get paid back quickly by operating cash flow. As the gentleman in the clip before said, he could buy GE when it was during COVID and people weren't getting their engines maintained on the aircraft that they serviced. But he knew that if things reverted back to the mean, that he would be handsomely rewarded at the price he was paying. And that came to pass. And It's entirely possible that Ford could fall over. I think it's highly unlikely, but it's possible. And so we're taking some risk, but at the price we're paying, it's an acceptable risk based on history of risk.
Well said. So let me get into it. Obviously, as I said before, huge company, $185 billion in total revenue for FY24, which is the calendar year ending 31st of December 2024, as Americans will know. But for any Australians listening to this, just reminding you of that. Average daily trade of $1.1 billion. So almost big enough for you to take a share in, Tony. And it scores really well on the QAV checklist. I do want to point out, this is a checklist I did last week. I haven't done one this week. So if anyone's considering buying it, do your own analysis, do your own research on it. But it was on our checklist last week. The price to operating cash flow is 2.34, which is one of the reasons it's doing really well. So for new listeners, one of the reasons we look at price to operating cash flow as opposed to price to earnings, PE ratio, which is what a lot of investors look at, is Tony believes that CEOs and CFOs have become a little bit clever about, I won't say fudging, but I'll say manipulating price to earnings. Your earnings, there's a lot of stuff that can be pulled in and out of earnings, and it can be hard to get a clear picture of what's going on unless you want to do a Buffett and get into the nitty-gritties of their numbers. Operating cash flow is a little bit harder to manipulate. It's a cleaner number. And so we tend to focus on that as a metric. And it's probably, based on our regression testing, the most important metric out of all of the metrics that we score on. Do you disagree with anything I just said, TK?
No, I just want to say a kind word to the CEOs of US corporate life. When I don't believe that they willingly manipulate balance sheets and P&Ls to their advantage, but they are able to do that. And so we guard against that by going to the top of the financial statements, which is operating cash flow. They can still be manipulated. And when I say manipulate, what I'm really saying is that there are a lot of assessments that have to be made by management in putting those numbers together. It would be lovely if all they did was go around to all the cash registers, count the cash on 31st of December, put it in the bank, and then say, here's our payroll and lease payments, 31st of December, and take one from the other. But there's a whole heap of assessments, and there's all the accounting rules have grown up to try and guide them on those assessments. But, how do you value your stock in the warehouse on the 31st of December? Is it the last in or first out? Is it the first in or last in? What is it, the average value? How do you value the deliveries you've made you haven't been paid for? There's a whole, how do you, provide for doubtful debts, all that kind of thing. So there's a whole heap of adjustments or assessments that management have to make to the financial statements to be able to draw a line under the business on the 31st of December last year and say, this is what our business looked like. Here's a financial snapshot at that time. That sort of leeway allows bad management to make assessments that look good for them, although that tends to be a short-term game and they can't keep doing it forever. And there are some signs to look at when you start seeing companies report normalized earnings over time. It's because they haven't been able to get away with the abnormal earnings that they've tried to declare or hide over time. But anyway, bad management can fudge the figures, as you say. Bad management can also make bad decisions about those numbers, and they've just provided the wrong amount for doubtful debt collection or valued the stock in the warehouse incorrectly, and that puts sand in the oils of the financial statements and in the gears, of the financial statement, and that can cause the number crunching to come to the wrong result. So I've just found over time that going to the top of the financial statements, which is a very simple operating cash flow, which is very simply, here's the revenue we gathered, and here's the cost of collecting it, and take one from the other, and that's your operating cash flow. And then you start worrying about inventory, you start worrying about debtors, you start worrying about provisions, you start worrying about all the things, how much you have to depreciate things, how much you have to capitalize, put aside for replacement capital in the future, how much you have to take as goodwill, whether the goodwill in your balance sheet is still accurate or whether it needs to be revalued, et cetera, et cetera, et cetera. All of those things are assessments, and all of those things can be, sometimes they're a coin toss. They can go one way or the other. But if it's not done properly and if it's not done with integrity, then they can be misrepresentative at the very bottom of the P&L, which is where they calculate price to earnings ratios. And we'll see it in our buy list that we'll have stocks with really good price to operating cash flow and reasonably high PE ratios. That's not a bad thing. It's management's being a bit conservative along the way, but we focus on cash flow because it's the purest that we can get numbers for to value companies. And I know that listeners to this will go, what about with the operating cash flow? All I'll say is that there are a lot more whatabouts about the PE ratio than there are about the operating cash flow.
Yeah, well said. So back to Ford, 2.34 is its price to operating cash flow, which is quite low and trickles through to the rest of our numbers. Now, one of the tricky things here, but this is true with a lot of big companies in the US, is they've suspended their guidance. They suspended it on May 5th, saying that with the tariffs in place, it made it impossible for them to figure out what was going to happen this year. There has been a number in one of their presentations I saw that they believe that it would cost the company about $2.5 billion in adjusted earnings before interest and taxes this year. But it's such a moving playing field that no one knows what's going on.
Yeah.
So a lot of their numbers are kind of up in the air. Some of our scoring is based on projected numbers. A lot of it's based on historical, but some of it is like forecast EPS and things like that. So that's one of the caveats here, as it is with any US company right now, is the numbers are all a little bit in flux as the tariff situation is clarified. But yeah, you want to say something?
I was just going to say that comes back to risk. We'll get paid back for the current purchase price of Ford within 2 years of it, based on its operating cash flow, based on that price to operating cash flow. So that's taking some risk, but it's taking minimal risk. And if things go bad for Ford and it takes 4 or 5 years for them to repay our purchase price, that may be okay. But if things get sorted out in the next 6 months or 12 months, and Ford goes back to where it was, then we get paid back handsomely. So that's the risk and reward, using price operating cash flow as a way of measuring it.
Yes. I mean, that's on the theoretical basis that we were getting paid all of the money from the operating cash flow for each share that we bought, per share amount, which obviously doesn't happen. We don't get all of that as a dividend.
No, well, I say what I mean is that we're paying a price and the company generates the cash to cover that price in 2 years, which is,
yes,
terrific, really. If we own that company 100%, we could decide to pay ourselves a dividend of 100% of the profits, and in 2 years we've got our money back.
Yes, but as investors buying shares in it, we don't know that means that the share price is going to go up that much in that amount of time. Or that we're going to get a dividend to neutralize the cost or any of those sorts of things.
No, but what it does mean is that the markets, traditionally, I'm sure the price to operating cash flow was much higher for Ford. And so it's discounted now because of all the risk. And if it regresses back to the mean, then the share price should follow. As Ben Graham said, the market in the short term is a voting machine, in the long term it's a weighing machine. Do we think Ford's going to go under? Well, it's a risk. I think it's got some smart people with smart contacts who will probably ensure it doesn't go under.
I don't think the issue is whether or not it's going to go under, but whether or not it's going to bleed money and how much money it could possibly bleed and what that could do to its financial prospects, its business. But anyway, I'll take you through where the business is at. Sort of the good. Let's start with the good. Their trucks and vans. So they're obviously, what does Ford do? They make cars and trucks and vans, and they have the credit arm, as I said before. What's doing well at the moment seems to be the F-Series, the Bronco, and the Maverick, what they call the Ford Blue Bucket, ran at about 7% EBIT margin in 2024, while the Ford Pro commercial arm grew revenue at 13% and posted an 11.6% margin last quarter. So that's where most of the cash is coming from with Ford, is trucks and vans. They're doing very well. They've got a great brand, obviously a very loyal customer base, probably a lot of fleets that are running them as well. So they're doing very well in that. Cash flow is pretty juicy. Consolidated operating cash flow was $15.4 billion in 2024, about $3.90 per share. So share price today is about $10.80. You're paying, as I said before, roughly 2.5 times operating cash flow. And even if you strip out the finance arm, the Ford credit arm, it only goes up to about 6 times. So still, we have a cutoff of 7. So even if you strip out the finance stuff, and the reason I say that is because it's, as we know, banking, finance businesses, their cash flow can be hard to track. It's sort of choppy with where the credit is and how the credit is managed and that sort of stuff. So it's a little bit hard to factor in necessarily where the operating cash flow from the finance arm is versus the trucks and cars and traditional side of the business. But again, at the end of the day, it's all money coming into the parent company, right?
Mm-hmm.
The dividend looks pretty good. They have a 4 to 5% dividend that they pay, and they've got free cash flow that seems high enough. I think after CapEx, it ran about $5 billion, so they should continue to pay a dividend, which is one of the things that we score them on. We like the fact if they're paying a nice high dividend, particularly if the yield is higher than the mortgage rate, which it isn't in this case, but we like companies that pay a dividend, not because we necessarily want the dividend, but we believe it's one of the things that a lot of investors look at, and it tends to provide a little bit of a headwind for stocks if they're paying a healthy dividend. At least that's true in Australia. Tailwind, not a headwind. Tailwind, yes.
Yeah, it's slightly different in Australia.
One.
So Australia, we get franking credits on our dividends, so that's preferred. Americans tend to not value the dividend as much and prefer to see the money reinvested back in the company. But the principle overall, I think, is that if the company pays a dividend, they're loath to cut it because they only have to cut it in bad times to try and preserve capital. So if the company's paying a dividend, it's a vote of confidence in the fact that the board sees the company as being able to continue to operate profitably going forward.
So that's the good news. The bad news is their EV division is bleeding really badly. It's called the Model E. And the Model E unit lost $5.1 billion in 2024, and management are forecasting it's going to lose another $5 to $5.5 billion this year. Kind of reminds me from that line in Citizen Kane, where Orson Welles says to his trust fund manager from when he was a kid, "You're right, I did lose $1 million last year, and I'm going to lose $1 million this year. And you know what? I'll probably lose $1 million next year. And at the rate, if I keep going at that rate, I'll be out of money in 50 years." So a little bit of detail on this. So they did $3.9 billion of EV revenue in 2024 and lost $5.1 billion. So it's roughly about $50,000 loss for every Mustang Mach-E or F-150 Lightning that they sell. Their EBIT margin ran at negative 195%. So not going well. So the cash that they're generating from the sale of trucks and vans, etc., is just being torched by the Model E division. And they've gone through, like Tesla, several rounds of price cuts. There's this price cut death spiral. They keep cutting the prices on the Mark E by $7,000 to $8,000, and lower sticker price obviously means lower margins. The resale values then get a punch too. So it's kind of this losing negative spiral that they haven't been able to turn around yet. I don't really understand the reasons for that, but I know Tesla's bleeding as well. Tariffs probably aren't helping that. So I don't know what's going on with the EVs in the US, but
have you seen the front page of today's Wall Street Journal? Today being the 20th of
No,
May.
because I couldn't subscribe to it. They wouldn't take my money when I tried to subscribe to it.
Really?
What does it say? Yeah, I told you that story a few weeks ago.
GM pushed EVs, but now aims to pull the plug on California rule, is the headline on the front page. General Motors went all in on electric cars. Now it is racing to reverse the nation's most aggressive EV mandate. We need your help, GM said in an email it recently sent to thousands of its white-collar employees. Emission standards that are not aligned with market realities pose a serious threat to our business by undermining consumer choice and vehicle affordability. So they're basically taking issue with the California measure, which will ban the sale of petrol cars and trucks by the end of 2035. They're asking their employees to lobby their Congress people to get that overturned.
What's that got to do with EV sales, though? Isn't that a good thing for EV sales?
Well, it's basically they're saying, well, the California rule is, but it's basically saying that GM doesn't believe they're going to sell enough EVs, but when the mandate comes in, they can do it profitably.
Well, back to Ford. Labour costs are going up too. Apparently, the UAW just locked in, in 2023, locked in a 25% wage rise over 4 years. And apparently, some of Ford's rivals, and I think that means Tesla, don't have similar sort of issues. So they've got some problems there. They've got some legal problems from the National Highway Traffic Safety Administration, the NHTSA. They've got some problems with their Blue Crews. They had two fatal Mark E crashes, and they might have to do a recall of all of those. And I saw in the news yesterday they're recalling 273,789 vehicles due to a loss of brake function. This is in the 2022-2024 model Navigator and Expedition vehicles.
Does the recall say drive it to your local dealer, but don't come in hot?
Good luck. Yeah.
Park outside.
Yeah. Yeah. Brake fluid in the affected vehicles may leak due to the front brake lines coming in contact with the engine air cleaner outlet pipe and getting damaged and exploding. No, it doesn't say that, but it's not good when your brake fuel pipeline is leaking. But that's, like, I looked at the numbers of that. It's kind of a mosquito bite, really.
Yep.
Like, cost them like $20 million maybe for a recall on something like that. Not a big deal. But then, of course, there's the tariffs. And it's, as we know, a lot of these cars, I think we talked about this. I'm not sure if it was on this show or the Australian show, when we were talking about decoupling from China, which apparently the Trump administration and the CCP now agree they don't want to decouple from their recent meetings. They said, no one wants to decouple. We don't want to decouple. We want to keep trading. We want everything to be great. So all of your decoupling fantasies are gone, Tony. But we know that automobile manufacturers, like everyone else, are sourcing components from hundreds of different suppliers, which are coming from all over the world, and a lot of them coming from China. Mm-hmm. And the sort of tariffs that were being talked about are still being talked about, even with the reduction, there's still massive impact on making things like cars. So how that's going to impact on steel and aluminium and components and loan rates, etc., no one can really see into the future with that kind of stuff right now.
I think I saw a presentation which said that a Ford vehicle traversed the Canadian border 18 times during its construction. So it would attract tariffs on each of those crossings for the parts that were in place at the time. So I think it was Ford was scratching their head saying, how do we even account for all the tariffs given we've got plants across the whole of North America?
Yeah. Kind of insanity. But, it's kind of an interesting from a value play, right? So it's got... it's struggling. It's got some issues, but still making a lot of money, even when you look at the impact of the Model E series problems. If they can fix the Model E losses, or if battery prices keep falling, which could affect their margins there, that could go straight to the bottom line. Whether or not they can compete with a Tesla or a BYD or any other of the EVs that are hitting the market, what the pricing of those is going to be, with tariffs and all that sort of stuff. No one knows how that's going to play out. But I think we all assume, at least I do, that EVs are going to have a big future. But again, it's a bit like AI. We don't know who's going to own that future and who's going to make the money out of that future. And so whether or not it's Ford, but they've been around a long time. They're a big company, a lot of smart people who work there. Chances are that they'll play a role in it. Whether or not they dominate it or not, who knows?
Just as an aside, when I was travelling last week down the south coast of New South Wales, there was a car park with EV chargers being put in. I think there's about 6 EV charging stations. And I said to my mate, what are those big green boxes besides the EV charging stations they're putting in? Turns out they're diesel generators to power the EV chargers. I'm like, doesn't that negate the benefit of an EV, putting diesel into the generator to charge the car?
I don't think it does, no. I think,
No?
I mean, look, the EVs aren't completely carbon neutral or fossil fuel free. It's about reducing the carbon footprint, not completely eliminating the carbon footprint. I mean, everyone knows, and I get Facebook posts sent by people all the time that talk about all of the fossil fuels that are used in the creation to make steel and aluminium, and to make the batteries and the wiring and the seats. There are still fossil fuels. There's still a carbon footprint to make all of that, but there's been tons of studies done on it. You're still coming in with a massively smaller carbon footprint if you drive an EV than you have if you're driving a fossil fuel based car. Massive. Like I don't remember the numbers, but it's enormous. But it's not completely carbon neutral or fossil fuel free, let's say.
Especially if you charge at a diesel generator.
Oh, Tony. So look, if Ford does look like a classic deep value play, great cash generator in an old business, sort of an ugly story, but a new shiny one in there somewhere as well. If the bleeding can stop before the balance sheet does, you're getting paid to buy in early and let them fix that. If not, sometimes cheap is cheap for a reason, and hence it's a value trap. But if I look at, I'll go through some of the numbers and show you where it comes out in the system.
And Ford have, by the way, just looking at Stockopedia, Ford have $35 billion worth of cash.
Yes.
Sitting on the balance sheet. So it's a long time before they bleed out.
Yeah, and like Rich was saying about GE when they bought into that in COVID, a lot of cash buys you a lot of years to fix problems.
Correct.
Right?
And to pay politicians to lobby with all the EV mandates to change.
Well, yes. Or tariff things to change.
Yes, or tariff
all
things
sorts
to
of
change,
things
yeah.
can change, yeah.
Mm.
So in Stockopedia, they have a quality rank of 50, so not up in the higher echelons, but not terrible either. Value score of 95, telling us what we already know. A momentum score of 64 and a stock rank of 85, which isn't terrible, but not high enough for us to score it on that. PE ratio of 9.5, earnings per share growth of forecast of negative 30%. So no one's thinking it's going to be a great upcoming year for them for all of the reasons that we've mentioned. But let me go down to my next sheet here. So they've got an F score of 6 out of 9. That's the health trend in Stockopedia, which is pretty good. Financial health, pretty strong. So we do like the look of that. Their total revenue has been going up. If you go back, so 2019, their total revenue was 155 billion, dropped in 2020 and 2021 for obvious reasons. Back up to 158 in 2022, 176 billion in 2023, 184 billion in 2024. And the forecast for this financial year is 182 billion, or down 163. There's sort of a couple of different numbers. The TTM is 182, but the 2025 forecast earnings is 163, which would be a drop back by a couple of years. But again, obvious things going on that are outside of their control, outside of the EV stuff, all of the tariff issues, which is going to make them take a hit, etc. Operating profit is an interesting one. I don't know what happened in 2019, but it was 519 million in 2019, dropped to negative 4.5 billion in 2020, again, for obvious reasons. Rebounded to 2.8 billion in 2021, 6 billion in 2022, 5.5 in 23, 5.2 in 24. TTM is 4.3. So operating profit and the net profit kind of tracks similarly to that, although in 2021, their net profit, coming from a loss in the COVID year, 2021, their net profit was 18 billion, dropped to negative 2 in 2022, up to 4.3 in 2023, 5.8 in 2024. Their TTM this year is 5 billion, and the forecast for 2025 is $4.2 billion in net profit. So obviously a lot of volatility in their profit there over a couple of years during and just after COVID. But they're making a ton of money, sitting on a lot of cash, as you said, generating a lot of cash. So, you're generating a lot of cash. There's a lot of moves you have to make. It's the kind of business that we like to see, right? Yeah. Generating a lot of cash,
yep.
And you can get it cheap.
Mm-hmm. And to be fair, like the quality score in Stockopedia was good but not great. So this is more at the value end of QAV rather than the quality end of QAV. But the fact that it has so much cash on the balance sheet and can generate cash in a sort of steady state process, even though there's all those issues you talk about. If you flick back through the annual reports, we're probably going on in almost every year that Ford has been in business, recalls and new product development and all those kinds of things. So it kind of isn't steady state at the moment, just a little bit volatile on tariffs. So we're buying it cheaply to compensate for that risk.
And yeah, as I said, it's generating a lot of cash. It's an old, boring business in some ways that's trying to get into the new age with the EVs and is struggling, but is sitting on a lot of cash, is generating a lot of cash, and has a bit of runway to work itself out and try and survive the turmoil of the current years.
And it's not alone in grappling with EVs as a legacy brand. I mean, one of the big companies will crack it, whether it's Ford or GM or Chrysler or Daimler in Europe, or Volvo seems to be making a good fist of their Polestar range. But I know that from reading articles about Mercedes-Benz, they're taking a bath on their EV range. So it's up and down for them all. And one of the reasons is China seems to be doing very well through brands like BYD. And, I think it was BYD, I could have that wrong. The CEO came out and said, we can charge an electric vehicle now in under 5 minutes. And if that's true, and if that gets rolled out, then that gives them a massive advantage in the market.
Does he require a gasoline generator?
Big diesel generator. Yeah.
You have to buy one with every BYD. You have to buy
tow it into the service station, fill it up with diesel, and drive it around, and then charge the car. It's a hybrid, Cam.
Before I get into the numbers, how we scored it, I did see this article that just came out today. Ford CEO has a strong take on tariffs.
I bet.
Yeah. Jim Farley is his name.
In relation to Chris?
Yes.
Right.
He looks just like Chris. He's Chris's younger brother, maybe, or older brother. Earlier this month, the company suspended its guidance for the year due to uncertainty around tariffs, despite its public championing of them. Ford says it supports the administration's goal to strengthen the US economy by growing manufacturing. However, it also said it expects tariffs to eat $1.5 billion of its EBITDA this year, with an overall $2.5 billion headwind. One of the reasons Ford supports the tariffs is that it already has a much stronger domestic production base than even its domestic competitors. Last year, we assembled over 300,000 more vehicles in the US than our closest competitor. That includes 100% of our full-size trucks, CEO Jim Farley said during the company's last earnings call. In this new environment, automakers with the largest US footprint will have a big advantage, and boy, is that true for Ford, he added. It puts us in the pole position. In March, the auto industry became the first major industry to get some relief from the tariffs when the White House announced an exemption for vehicles covered by the United States-Mexico-Canada agreement, etc., etc., etc. Farley has been very effusive about tariffs. Ford truly believes in US manufacturing, and if extra tariffs on foreign-built vehicles will help achieve that outcome, then so be it. So they're all for the tariffs, apparently, because they have US-based manufacturing.
Okay.
So anyway, if the tariffs go ahead, they stick to some of them?
So they're all for the tariffs, but they suspended guidance on how tariffs will affect them.
Yeah, right. All for it.
Yeah.
But throwing their planning into a little bit of array.
And the other benefit of we don't have to guide the market on our profit.
Well, that is forward. Good. So I'm just going to run through our scoring just quickly. So quality rank of 51 on Stockopedia, as I said, we only give them a score if they're equal or above 60, so they don't get a score for that. Stock rank is less than 90. I think I said it was 80, 85, something like that, so we don't score them on that either. They do get a score for the F score, being equal to or above 4.5. They don't get a score for the Z score. The price is above both of our intrinsic value calculations, so we don't score them on that. However, it is below book price and, of course, also below book plus 30. Only just, though. I think the book price is about $11 something. The price today is about $10.80. It was about $10.50 when I did the analysis last week, but at $10.80, it's still below book and book plus 30. It has a 3-point uptrend, but it also has a new 3-point uptrend, so it gets a score for that. The growth over PE is not greater than 1.5, so we actually give it a negative score for that. Book value growth is not positive. PE is not less than the yield. The yield is not greater than the bank debt. the forecast IV is not greater than twice the price. It's not even current IV is not greater than the forecast is not greater than the current price. So it doesn't get scores for any of those. So it ends up with 7 out of 15 gets a quality score on our end of 47%, which is interesting because that's pretty close to what it gets on Stockopedia's quality rating too. They gave it a quality of 50. We gave it a quality of 47. So we're pretty much on track with them. But it gets a QAV score of 0.2. So again, as I said, at least when I did the analysis last week, and I don't think anything would have changed since then because the share price is only $10.80, as I said. It's on our buy list, and interesting. Yeah, an interesting sort of classic sort of a value play, I think. Really big companies like that we usually don't expect to see on QAV, but in this case, big company, generates a lot of cash and has some struggles, and obviously the market isn't giving a lot of love right now.
Did you give any consideration to the Ford family ownership in terms of scoring it as an owner-founder at all?
I don't, because as I said before, I've told you in earlier episodes, Stockopedia doesn't let me download that in my spreadsheet.
No, I know.
So yeah, I don't go back and rescore everything manually afterwards. I could, but But you've looked at it? Have you looked at it?
So Stockopedia don't show the Ford family ownership, but if I Googled it,
Right.
It said members of the Ford family own Class B shares in Ford, which grant them significant voting power. Even though the Ford family's ownership stake in the company decreased over time, they use these Class B shares to control 40% of the company's board of directors, while the remaining 60% are elected by holders of publicly traded Class A shares. This ensures the family retains operational control despite owning less than 50% of the company's equity. So they still have control.
And so from your perspective, is that a good thing for us or a bad thing? Or
a good thing, I think. I mean, it's not Henry Ford still there, but members of the Ford family is still there. And they would have a lot of experience in automotive manufacturing.
So there you go. It's one to look at. We don't hold it in our US portfolio, but it's something to look at. If you're out there and you're looking for a value buy, have a look at Ford.
Interesting one.
Research.
Thanks, Cam. It's not often we see big corporations that have been around for a long time on the value buy list.
That's what I thought too. All right. Well, after hours, Tony.
Yes, Cam.
So for new listeners, after we get through talking about investing, Tony and I usually will do what we call after hours, where we just get to talk about what we've been doing lately, what we've watched, what we've listened to. Tony has very good taste in TV and film and music and books, and he has a lot of time to watch and read and listen and play golf because that's all he does. Unlike some of us that work for a living. Tony tried that. Didn't take.
No, it did take. I just got through it quickly.
Compressed it down to
20
years.
Yeah, correct.
Yeah. We're into after hours, Tony. We skipped it last week. Got anything good for me this week? Got any tips? Got any recommendations?
Well, I haven't watched much because I've been travelling and playing golf and some fantastic golf courses in southern coast of New South Wales. Recommend people go and play Mollymook and Narooma golf courses if you haven't. They are very good. Narooma in particular, right on the coast on cliffs. You shoot over cliffs on at least one of the holes, which is fun. But when I got back on the weekend, I watched a couple of episodes of Mobland, caught up with that, and it really is standout. I highly recommend Mobland.
I've got to check that out.
Tom Hardy and Pierce Brosnan and Helen Mirren, all fantastic.
Okay. I do love a bit of Helen Mirren.
She seems to be in everything at the moment, doesn't she? She's in coming out in the, what's it called? The Detectives Murder Club or whatever it is, the books that Richard Osman wrote. Is it 1823, the prequel to Yellowstone, and she's in this. And she must be in her 70s. I mean, she's still very active and doing great.
But she will never be in anything better than Caligula. Caligula, chef's kiss.
Oh, really?
Yeah.
Oh.
Oh, yeah. The fact that she was mostly naked running around in it's got nothing to do with it. But yeah, one of my favorite films, Caligula. Love it.
Really?
Love it. Oh, it's a masterpiece. It's bonkers, completely bonkers. But that was kind of the point, right?
Right.
They're trying to depict Caligula's reign as bonkers, which is probably unfair to Caligula. I think he's been badly treated by history. But yeah, she was in her absolute prime in the early 70s. Don't know how old she was, but probably about the same age as what's his face, who was in it with her.
Malcolm McDowell.
McDowell, yeah.
Malcolm McDowell, anyway. McDowell.
Yeah, Malcolm McDowell. Would have both been in their sort of mid to late 20s, I guess.
And Pierce Brosnan's great too in Mobland. He's reverted back to his Irish accent. Doesn't use the English Bond anymore. Yeah,
right.
Really, just the mob boss, the patriarch of the family. Oh, Cameron, I told you had to do that. You didn't do it when I told you. You will do it now.
Has he still got the beard? He had to grow the beard to get away from Bond, I think.
Okay. Oh, I can't recall. I don't think so. Maybe. Can't recall.
Every time I've seen him on chat shows, he's had beards.
Okay.
Well, I've been watching Black Mirror. I watched the first episode of the new season of Black Mirror. Have you seen that yet?
No. I'm still going
Terrifying.
back, looking through the old ones.
Oh, right. This one, first episode of this one, absolutely gut-wrenching, terrifying. Chrissy and I watched it the other night. She was like, well, that was not the good thing to watch before I went to bed. That was horrible.
Oh, nice to keep it.
Yeah, no, it's good. I mean, it's terrifying. It's basically about corporations
unrealized
getting
gains.
in. Yeah, I know that's what keeps you awake at night.
Yeah, it's terrifying.
Yeah, that should just be a Black Mirror episode. Albo taxing unrealized gains. One day in the future. I started watching Total when I was cleaning the kitchen last night.
I told you, Anthony, you can't do that. You've got to listen to me.
I started watching the Schwarzenegger version of Total Recall from 1990. That could have been a Philip K. Dick short story. Like, one day in the future, governments will come for unrealized gains. As the most that's your version of a dystopian.
What was a Philip K. Dick short story?
Coming for unrealized gains?
No, I can remember. We can remember it for you wholesale. That was the.
Yeah, I'm saying that could have been another book that Dick wrote. In a dystopian future, they come for your unrealized gains.
When the coalition is split, the government will come for your unrealized gains, and there's no Greens to stop them.
I'm also halfway through watching Rashomon for the first time. I've never seen Rashomon before.
No, neither have I.
You haven't seen it?
No.
Good.
That's the one
really good.
The same incidents repeated by different recollections.
How do you know that if you've never seen it?
Oh, well, it's part of movie folklore. And it was the basis for, what was the Ridley Scott movie I recommended last year or the year before? I think it was on Netflix with Matt Damon and Ben Affleck. And
as long as it wasn't Napoleon.
No, the lady from Killing Eve was prior to Napoleon. It was based on Rashomon. It was 3 stories of a rape, as to who recollected it.
So Rape-a-mon?
She got a rash.
Yeah, like it's true. I mean, I'm halfway through it, and I couldn't watch it while I was cleaning the kitchen because it's all subtitled. So I need to pay attention to it. It's the one I watch when I get home from Kung Fu and my body hurts, and I have to lie there and stretch and massage my muscles out. Fox had his Kung Fu grading on the weekend. He got a new belt. So he got his 4th belt. It's his 4th grading. No, 3rd grading, 4th belt, because he starts with a belt. He did really well. I was really proud of him.
Good. What color belt's that?
This is the middle blue belt. So there's 3 blues. It's the second of the Three Blues, and there's not many kids that get that level belt. You know, out of all the kids that we've seen in the 4 years that we've been there, not many stick around long enough to get that. He's been going 3 years now, so it's not many kids last 3 years at Kung Fu. You know, 10% maybe. So he's doing really well, and it's interesting to watch him slowly getting more serious about it. You know, as he gets better and he starts to realize that he's actually getting pretty good. He sparred with the adults afterwards on Saturday. He gets in and joins our sparring matches, and he holds his own, man. Like he's got the instinct for it. A lot of people, even adults in sparring, I mean, we go easy with the sparring. Like, no one's trying to hurt each other. It's got gloves on and whatever, mouth guards. But a lot of people, you throw a punch at them and they'll turn their head, you know, an instinctive blink or shut their eyes, turn their head. Not Fox, man. He just comes in and gets underneath it and starts hitting me in the ribs and hitting me in the kidneys, and he's in the groin.
You might live to regret all this, Cam.
Yeah, probably, or not live to regret it because he kills me.
Search his bedroom for a diary. I almost got Dad at Kung Fu this week. I'm getting better. It's only a few days now.
Yeah. Countdown.
Yeah.
The
Last Duel. The Last Duel was the Ridley Scott movie based on Rashomon.
Oh, I've seen The Last Duel. No, not The Last Duel. No, I'm thinking of his first film. What was his first one? The Duelist. Yeah. No, I remember you telling me about this. Okay. Oh, Ridley. I can't watch Ridley anymore. Ridley's broke my heart with the Napoleon film. I'm reading Tinker Tailor Soldier Spy.
Yeah, good on you. Good book.
Enjoying it. Yeah, I'm halfway through it or third of the way through it. Enjoying that.
And there's a great version of it that came out 10 years ago or so with all the great British actors in it.
Gary Oldman in that one?
Yep.
As Smiley?
John Hurt, yep.
And then Alec Guinness, I think, played Smiley in the 70s version. Oh, series. Yeah, right. Yeah. I haven't seen any of those, so the story's all new to me. But I'm enjoying it. And I've got a band for you, if you've never heard of them, Tinder Sticks.
Did you mention that last week? Is that the girl band?
No, that was Teen Jesus and the Gene Teasers.
I saw a clip just recently too of Amel and the Sniffers on one of the Tonight shows.
Fallon or something? I haven't seen that yet, but I've seen it promoted. I really want to dig it up and watch it. I'm so happy for them.
Yeah.
So happy for them to be getting this sort of US coverage. Yeah. Such a great Australian
especially on Jimmy Fallon, right? It's like, you know, all these Midwestern farmers in New York going to Jimmy Fallon, whooping and hollering, and then this white girl from Australia gets up and jumps up around into a punk band. It's fantastic.
I guess it wasn't one of the songs where she swears a lot in it.
Possibly, you can hardly
hear
what she's saying. So,
all right. Oh, I love Amel and the Sniffers. Just so much fun. Like I've seen a couple of their concerts on YouTube, and I just have this huge grin on my face through the whole thing. It's just so the joie de vivre in watching them. It's so great. No, Tinder Sticks I just discovered this morning, and it came through a Spotify recommendation based on, you can say, like a radio thing. It was based on Dirty 3. I'd been listening to Dirty 3, created Dirty 3 Radio, and Tinder Sticks came on. So Tinder Sticks is sort of a cross between Dirty 3 and Nick Cave and Leonard Cohen. UK trio, started in the mid-90s, piano, drums, and violin. But when Nick does his sort of mellowy, ballady stuff in the last 20 years, it's kind of very much like that. Okay. Quite lush, a lot of strings, a lot of piano, and the vocalist is very Nick Cavey in his mellow, older sort of kind of Nick era.
Yeah, right.
Papa Won't Leave You Henry, Nick, and not birthday party Nick, but version 4 Nick, whatever it is. But I've been listening to it while I was working. It's beautiful sort of atmospheric, ambient kind of thing going on. It has lyrics, but it's, nice. Chrissy liked it too. I played it to her in the car on the way to Kung Fu. So there you go. Tinder Sticks.
Actually, I had one.
That's my music tip.
Wrote down a couple of weeks ago to recommend to you in that similar vein. are the Veils. Have you heard them? And they have a track called Sit Down by the Fire, which it could have been Nick Cave singing it. It's a ballad like that too. And
VEILS?
Yes,
Oh, yeah.
that's right.
English New Zealand indie rock band, according to Wikipedia.
And Sit Down by the Fire is the song I recommend of theirs.
Sit Down by the Fire. All right. Well, there's my listing for tonight. Thank you, TK.
Yeah, good. Thanks, Cam. Have a good week.
Thank you, Tony. You too.